All right, we are on chapter 10. We are on the last chapter before this class is over. Okay, so just a little preview. I plan to do objective 10.1 in a video and 10.2 in a video by itself and 10.3 by itself, and then I will combine 10.4 and 10.5. And I don't plan on doing 6 and 7 because those are ratios. And again, we've got a whole chapter on ratios coming up in Principles of Accounting 2, which you will be there pretty soon if you are still here at the last chapter of Principles of Accounting 1. So let's dive in. So the first thing we're going to talk about is the cost of property, plant, and equipment. So I like to always draw out the accounting equation so you kind of know where we're at in the process. The previous chapter was on that current asset receivables, and then we have long-term assets, and very specifically in the long-term assets, we are talking about property, plant, and equipment. This is your land, your building, your vehicles. They are tangible. You can touch them, feel them. There are intangibles we'll get to later on in this chapter, but measuring the cost of those items. Okay. Up to this point, we just kind of always said, hey, this is what we purchased it for. But you realize if you've ever bought a house or if you've ever bought a car, there's a lot more that goes into those assets than just the purchase price. Okay. Some of these are very easy. There's um, some little different kind of things in each one of these that we want to make sure we grab because they're just not intuitive. Like we know the purchase price, probably taxes, transportation, all of that would be included in the cost. And when we say the cost to bring that asset to its intended purpose. Okay. So, and we're also going to depreciate these items. Now, remember, we do not depreciate land. Okay. We will depreciate everything else under property, plant, and equipment, but we will not depreciate land. Okay. And we do that because we want to follow the matching principle. So think about if Walmart purchases a building in year one and they're going to gradually use that building over the next 30, 40 years, the cost of that building, it wouldn't make a lot of sense to expense it in the very first year, right? It would make more sense to allocate the cost of that building over the time period that we expect that building to last. Okay, so that's depreciation. Remember, we learned how to do the depreciation journal entries back in chapter 3 because they are adjusting entries, and we have that contra asset account. Okay. So let's look at the life cycle of a plant asset. Okay. We acquire it, then we're going to use it, and then we're going to dispose of it. Okay. Sometimes disposing of it could cost us money, not necessarily bring us any money, but if we sold it, we would be disposing of it. And that is the life cycle of all of these plant assets. Okay. We are following US GAAP accounting, so we are going to follow the cost principle. Okay. The cost principle states that we're going to record it at the cost, not the fair market value. Okay. I've told this story before when many years ago, my husband and I bought a minivan after a tornado hit this car lot. And we only paid like $12,000 for this minivan, and it didn't have any windows. They replaced all the windows, but it was worth about $26,000. Okay. We, of course, that was our personal side, but if we're a business, I could not record that fair market value on my books. I have to record it at the cost that I paid for it because that always makes us feel good, right? Oh, yay, I got this asset for like $10,000 less than the fair market value. I would argue that the fair market value is what you paid for it because nobody else was willing to pay $26,000 for it. Okay. If we switched over a little bit, just in contrast, international accounting actually does not follow this rule. They actually go, they follow the standard of the fair market value on assets. So it's a little bit different. If you're an accounting major, you probably have me for international accounting. If you're an international business major, you will definitely have me for international accounting and law. Okay. So, what are the things that go into making up the cost of each one of these assets? Okay, let's talk about land and land improvements. So, the first one's land. Some of these are very obvious: purchase price, commission, survey, delinquent property taxes, title transfer fees. The one that is very different for here is the cost of clearing the land. So let's just say, for example, you buy a piece of land, it's got an old building on it, and you plan to raise, that's the word they use, a building. You are going to bulldoze it down. You're going to blow it up. You're going to get rid of it. You are not going to use the existing building on the land. The cost of clearing that building will go into land. Some students want to think that it'll go into the new building. It does not, because we are trying to get this land to its intended purpose, and clearing an old building is goes into the cost of the land. Okay. The next one is land improvements. Remember, land, none of that gets depreciated. It stays on our books at what we paid for it forever. Okay. Then we have land improvements. These things are subject to decay and they will have to be replaced. Fencing, paving, sprinkler systems, lighting, signs, all of those things are going to be put into an asset called land improvements. Okay. These are subject to depreciation because none of these things are going to last forever. Okay. So they give us an example here. Smart Touch Learning purchases land on August 1st, 2026 for $50,000 with a note payable. Other costs include $4,000 in delinquent property taxes, $2,000 in transfer taxes, and $5,000 to remove an old building and $1,000 survey. Okay. So we start with the purchase price of the land. That's where we're always going to start. They paid the taxes. They paid the transfer taxes, the removal of the building, and the survey fee. All of those things are going to go into the cost of the land. Okay. And we're going to pay for those, and we're going to list land is going to be on the balance sheet for 62,000. Let's see it. Do they make the journal entry? Yay, they do. So the entry, this is going to be a little bit bigger one, maybe. Um, it's got three titles here, but land, what did I just tell you? That came from right there. Okay. They told us that the 50,000 was on notes payable, and I'm guessing they said they paid all those other things in cash. Maybe they said it in the book. I don't think they said it on the slide. But all of that gets capitalized into the cost of the land. Okay. That's the asset. Notes payable is your liability, and your cash is also an asset. Okay. All right, let's look at land improvements. Smart Touch Learning pays $20,000 for fences, paving, lighting, and signs on August 15th, 2024. Okay, we're going to debit land improvements, credit cash for $20,000, and we will depreciate that. Okay. All right, let's get into buildings. Okay. Like I said, a lot of these are very self-explanatory, but there's a few things I'm going to pull out that are not as self-explanatory. Okay. Architect fees, building permits, contractor charges. Um, that's if they're constructing a building. Payments for materials, labor, and miscellaneous costs. You could just purchase it. Okay, you could just purchase the building and then renovate the building and get it ready for use, which everything in the renovation would go into constructing a building and then probably eventually moved over to the building category. Okay. One thing they don't mention right here that I always like to throw out is if you had gotten a construction loan to build this building, then any interest that was accrued while it was in construction gets added to the cost of the building because that was something that it took to bring that building to its intended purpose. Any interest after that is just interest expense. Okay. Then we have machinery and equipment. Machinery and equipment. A lot of these sound great, right? Transportation, insurance while in transit, sales tax, purchase commission, installation cost. Then the one that stands out that might not be so self-explanatory is testing costs. So I always think of like maybe they're going to add a module onto an assembly line. They're not just going to stick it on there and say, oh, it's going to work right the first time, because that's probably not going to happen. They're going to use some materials, whatever they're making, to test it. Any materials used in that testing phase also gets added to machinery and equipment. Okay. Then we have furniture and fixtures. Those are our desks, chairs, file cabinets, display racks, all of those. Okay. All right. Now we're going to talk about a lump sum purchase. Okay. We are always going to use the fair market value to actually figure out what we paid for these goods. So you're going to see they call it a basket purchase. So you may buy a building and land together. You know, me and my husband built a house a couple of years ago. We bought the land and then we made the building. Okay. Or hired a contractor to build the building. Okay. But you may buy all these things in a lump sum purchase. Okay. So if you're a business, you may buy a building, land, and equipment. Okay. Remember that land doesn't get depreciated. So we can't just let a manager decide on what value to assign to those because depending on maybe where their bias is, they may want more money to go into the land because they want less depreciation, and their bonuses could be based on earnings. Okay. So we don't trust the manager to make that decision. We go out and we get a market price of every one of those items, and then we base it on that because that's outside numbers. Somebody else came up with those numbers, and then we are going to use those numbers to figure it out. Okay, so here we go. We have a lump sum purchase. Suppose Smart Touch Learning paid $100,000 on August 1st, 2026 for the land and the building. An appraisal indicates the land's market value of 30,000 and the building's market value of 90,000. So we paid $100,000 for assets with a fair market value of 120K. This is back to that example. Wow, we got a good deal. That's awesome. It makes us feel good too. Even though I would probably argue the fair market value is really 100,000 because that's what somebody was willing to pay. All right. And we have to separate these. We can't just stick them on the balance sheet as building and land together because the land doesn't get depreciated, but the building will. Okay. So we got the fair market value of 120,000. I'm not sure I really like how they did this. Let me do it just a little differently over here. So we had land. You know what? I'm gonna come over here. We had land with fair market value of 30,000. We had a building, fair market value of 90,000, which gave us a total of 120,000. Now we're going to get a percentage. Okay, I'm gonna pull my calculator up here from my previous video. We're gonna take 30,000 and we're gonna divide that by the total of 120,000. And I was hoping it would be nice, pretty round number. That's 25%. So we'll take 30 divided by, let me make that a little better, divided by the 120. Well, we only have one other asset. Process of elimination tells us that that's probably going to be 75%. But if you're a little OCD, you can always put that in your calculator to make sure you get the right number. So that's 75%. So we'll take that number and divide it by the total. Okay. So we paid $100,000. So we're going to take that percentage, multiply it times 100,000, which will give us 25,000, and then multiply the 75% times the 100,000 to give us 75,000. Check figure. Those two numbers should total the total amount for costs because you might have a homework problem that's going to give you three or four different items in a basket, and you're going to have to do that calculation. So remember that 100,000 should equal the total cost. Okay, so they did all of that right there. I just didn't really like it. It kind of looked really muddy, and me writing it down, you actually watched me do that and makes it a little bit more sense. Okay? So, oh, this is the calculation I had. Okay? Much better. I like that one because it's exactly like mine. Okay. Said that we purchased those assets with a note payable. We're going to debit land for the 25,000, debit the building for 75,000, credit notes payable for the 100,000. We cannot recognize that extra $20,000 as a gain or revenue or anything like that. Now, I know I said international reporting standards actually can do that. There are some other rules that go along with that, but they don't necessarily follow the historical cost principle like we do here in the United States. But any U.S. company actually has a choice of using GAAP or international financial reporting standards. So there is a lot of companies here in the US that are actually using IFRS because they have some international presence. So you just have to be careful about which business is using which method or which standard. Okay. All right, we're going to talk about the difference between capital expenditures and revenue expenditures. So, as an asset ages, there's going to be different things that you're going to have to do to it to make sure it stays in operation. Okay, so just for example, if you have a car and the motor has gone out in the car and you are going to put a new motor in that car, that is a capital expenditure. Okay. It gets added to the cost of the asset. We're going to get to calculate depreciation. We would have to calculate a new depreciation based on that capital expenditure. So if the whatever you're doing extends the asset's useful life or makes it more efficient, then it is a capital expenditure. Think about that same car for a revenue expenditure. What if you just change the oil? And I'm not a car person, but I do know a little bit. I do know when the salesman, when I take my car to get an oil change, if the glorified salesperson tells me that I have an oil leak, and then he shows me a tiny drop of oil that has dried there, that was a drop of oil from the previous oil change, and tried to tell me I had an oil leak, and I did not have an oil leak. I'm not that dumb. So I just get the oil change, and I realize an oil change could extend the useful life of an asset, but it's a very nominal amount. So it would just be a revenue expenditure. We're just going to um, debit auto expense or something like that, credit cash or however we paid for it, and it's going to go straight to the income statement. Okay. Capital expenditure is going to go to the balance sheet first, then later on to the income statement. Revenue expenditures go straight to the income statement. They bypass the balance sheet. Okay. So they give us an example here, capital and revenue expenditures, spending $3,000 to rebuild an engine on a 5-year-old truck is an extraordinary repair because it extends the asset's life past the normal expected life. Okay. So they're just going to debit the truck. This is the asset that is actually the long-term asset of 3,000 and credit cash for $3,000. Okay, this is the example of it's going to go to the balance sheet first, then it will get depreciated, and then eventually end up in the income statement. Okay, so then they give us another example. Smart Touch Learning paid $5,000 cash to replace tires on the truck. This expenditure does not extend the useful life of the truck or increase its efficiency. That is a revenue expenditure. So it will go to repairs and maintenance expense and credit cash. Okay, go straight to the income statement. All right. So I think this is getting close to the end of this video. We have a list of things on a delivery truck that would be considered a capital expenditure. A major engine, transmission overhaul, modification for new use, addition to storage capacity, anything that increases the useful life of it would be a capital expenditure. Revenue expenditures, a repair of the engine or transmission, oil change, lubrication, replacement of the tires and windshield, or paint job. All of those would be revenue expenditures. Okay. They always are throwing data analytics into each one of these if you want to pause the video and read those, or if you want to go and look at those in the PowerPoint in Canvas, you are free to do that. We are done with Objective 10.1. We will pick up next on Objective 10.2.